Welcome to UK Prime Time once again. I believe everybody is doing good. Yes, we have the next update round the corner, and any day, any hour from now, we can push it live. Once we ensure that it's working perfectly fine in
Mhm.
terms of scaling it to at least 5 to 10,000 users at one go, we'll push it live. We have so far tested, and everything works so beautifully well. Um, can't wait to see you all getting your hands on smart money. Without wasting further time, I would straight go into episode 15, right? Today we are
Yes.
going to get into episode 15.
Mm.
After today's episode, we are going to slowly move towards prop trading in terms of our learning curve in Lift Before You Quit. So, from today, today's, I believe, the second last session in which we are going to thoroughly go through smart money, self custody. Then we move towards prop trading, and post completion of prop trading, this is the roster of Swift before you quit. So post completion of prop trading, we are going to cover a new and different vertical that I'm not going to talk about right now, but something that was not even expected, that was not even, we also did not think about building something which we have integrated in Rift already. So, as a tech team, we planned smart money, we planned auto trading engine, we planned swipe execution, we planned futures, spot trading. But this feature we did not even, plan, because this is a new and uh, you can say the latest integration on Hyperliquid, and we are the first team, first organization to develop on top of this technology. So, yeah, this is going to be the first integration on Hyperliquid that we are going to do with this functionality. So, the next up functionality is something that we also did not, as a tech team, imagine that we could integrate or build, and we built it. It's working beautifully fine. All right, so without wasting further time, let's get into episode 15. Welcome once again. The self custody evolution. Why the future of wealth may not need traditional banks. Welcome once again to episode 15. In previous episode we explored how artificial intelligence is reshaping financial participation through infrastructure, automation and intelligent capital systems. Tonight we explored another transformation that may prove equally important: ownership. For over a century, people have trusted banks to hold their money, process transactions, manage access, and safeguard wealth. But what happens when technology allows individuals to become their own bank? What happens when ownership moves directly into the hands of the user? Welcome to the self custody revolution. The original purpose of banks. To understand where finance is going, we first need to understand where it came from. Correct. Traditional banks solved several important problems: safe storage, payment processing, lending, record keeping, trust, of course. Without the trust in bank, you will not hold your money with the bank. You will not deem bank as the custodian of your assets which you have kept with them, because you have government's promise with you, government's backing by the banks. Banks are licensed by the government, and that's why you trust banks, that they will not run away with your money. But why to trust banks when you can hold the custody, ownership of your own assets by yourself? For decades, these functions were essential because every individual, ordinary individuals, had no practical way to manage financial infrastructure themselves. Banks became the gatekeepers of money. Ownership existed, control often did not. Let's take real world example. A bank customer may technically own their funds. However, withdrawals can be delayed, transfers can be restricted, accounts can be frozen. Banking hours can limit access. The asset belongs to the user, but the infrastructure belongs to someone else, that is the bank. Traditional finance model, I mean, we all know this. User interacts with the bank, bank has intermediaries. I mean, bank itself is an intermediary, then there is the financial system, and then there is asset access, which has control flows through intermediaries like banks and exchanges and currency converters or forex converters in the background whenever you transact globally. Now let's come to our elephant in the room, self-custody. What is self-custody? Self-custody changes a single but powerful idea. Instead of trusting a third party to hold your assets, you directly control them yourself. In simple definition, self-custody means you hold the keys, you control the access, you authorize the movement, you maintain the ownership. No intermediary required. If we compare it to real world example, imagine owning gold. You could store it at a bank or keep it in your own vault. Both options involve ownership, but only one involves direct control. Self custody applies the same principle to digital assets. Not your keys, not your assets. Why the world is moving towards self custody? Trust is changing, technology is changing, and finance is changing. Over the past decade, digital assets emerged. Blockchain came into existence. Blockchain infrastructure now matured. Global payments accelerated. Decentralized networks expanded drastically. As a result, millions of new users now hold assets directly in their own custody. Global crypto ownership has grown into hundreds of millions worldwide. Billions of dollars are now held through self custody wallets. The trend continues to accelerate. And if we look at the figures, it's growing exponentially in terms of number of users holding digital assets such as crypto. Back in 2015, if we compare to right now, it's around it used to be around a million people holding digital assets in their self custodial wallets. But as of now, if we see, there are more than 60, 70 million users holding crypto or digital assets in their wallet. By 2030, we are expecting around 120 million users holding digital assets independently in their own custody, that is self custodial uh, structure. Programmable money. Let's understand what is programmable money. Traditional money moves through institutions. Programmable money moves through rules. This changes everything. Money can now execute automatically, follow predefined conditions, interact with applications, participate in ecosystems without requiring manual intervention. Let's take an example. How a traditional bank transfer takes place. Person goes to the bank or interacts with the bank, bank processes the payment or transaction, and recipient receives the amount or the funds that the user has initiated through bank. Programmable transfer is what? Programmable transfer is very simple. When the conditions are met, then execution is triggered and funds they move automatically in your custody or wallet or bank account. Just like autopay or automated ACH. The future of money may behave more like software than paper. This we need to understand and accept as a fact, especially elderly needs to accept this as a fact that in future money will behave more like software than paper. On-chain wealth management. One of the fastest growing areas of finance is on-chain wealth management. Instead of managing wealth through advisors, brokers, institutions, Users increasingly interact directly with financial infrastructure. For example, assets can now be stored, allocated, deployed, monitored, rebalanced across multiple ecosystems, all while remaining under your ownership. Now, if we take an example with Rift, you can trade with swipes. You can put your funds in auto trading engine. You can allocate your capital into smart money. You can do futures, spot trading, while everything you can do while maintaining your own custody in your self-custodial wallet address. So now, definition of financial infrastructure. Activity of money has changed. Rise of tokenized assets, decentralized protocols, digital financial infrastructure signals a major shift towards direct participation models, which is bringing financial sovereignty. So, self custody is not just a technology discussion, it is a sovereignty discussion. Financial sovereignty means controlling your assets, controlling your access, controlling your participation without dependence on centralized gatekeepers. For an example, in traditional model, there is permission required, and then the access is granted, and then there is participation. Just like the IPOs you subscribe to in stock market, you buy a lot, you buy an IPO, you buy a stock, pre-subscribe, or you buy in an high net worth individual deal, then you request for the permission for the access, and the once the access is granted, you get the participation. In self custody model, whereas opposite happens. Hmm. If you have ownership, you have direct access, and then there is participation. It's other way around entirely with self custodian model. The future investor may not ask permission to participate very clearly and simply. This is the real financial sovereignty, or you can say the real sovereignty. Control versus ownership, the same thing that I explained. If you have the control, you have the hold, you have the access, then things, the process is other way around. It is not request, then grant of the request, then you have access, and then you do things. When you have the control, then access or participation is the end thing that you do. You have the control, you participate. User owned infrastructure. The next evolution is not simply self custody, it is user owned infrastructure. Historically, platforms owned infrastructure, users rented access. It is very important subject that I'm going to cover. So make sure if you don't understand, then raise your hand. I'll explain it one more time. This thing, user owned infrastructure. This will build extra clarity as to what we are doing in terms of protocols and how apps are working in the financial atmosphere. Historically, platforms owned infrastructure, users rented access. Future systems may increasingly allow direct participation, direct ownership, direct interaction through decentralized networks. For an example, initially internet revolution came when users could read only on the internet. Then slowly and gradually we moved towards written writable internet, where read and write both functionalities were there on internet. And then internet swiftly moved towards the ownership, where we could own assets, websites, applications, softwares on internet. So internet evolution moved from read to write to own. The same transformation is beginning in finance. Now just uh, relate this like I think we took an example of GPS. No, I don't think here we took the example of GPS. Just think about internet. When first internet came, it used to be the read only space where people could only access to information through search engines, through websites, and then people got the power or ability to write and express their opinion or uh, emotions or whatever on internet. Then it became read and write both. And then post read and write ability, it moved towards ownership, when users, end users, business owners could own assets on internet, websites on internet, softwares on internet. So similarly, the transformation is beginning in finance. Initially, in traditional finance, when you talk about old times, even we will discuss about the genesis of prop trading also, how traders used to be called in the floors to sit and trade, you know, submit their phones or devices, and they were called to sit and trade. Similarly, finance used to be a very traditional or complex or read only environment in which the stock market used to run on paper. The transactions in the banks used to be logged on pieces of paper, and then slowly and gradually it got recorded on internal servers of the banks, and then it moved towards the internet, where it is accessible now with the users as well. First banking came on intranet, and then banking came on internet. So it finance also swiftly moved from read only to read and write, and then it is now moving towards owning also what you can access. So this is a perfect example of um transformation in finance if you can connect with the evolution of internet. Self custody does not mean doing everything yourself. Now comes the real connection or understanding, which is going to make your, you know, open your brains enough so that you understand how these things work fundamentally. One of the biggest misconceptions about self custody is that users must manage every decision themselves. That's not what the future looks like. The future combines ownership with intelligent infrastructure. You keep control, technology assists participation. The distinction is important because self custody does not mean becoming a full time trader. We're not asking you to open and close positions with smart money, or take, even decide yes or no with smart money which position to go with. It's your custody, it's your ownership, but there is combined ownership with intelligent infrastructure so that you have control, but technology is assisting your participation. So now you understand self custody is not just a concept which is defined or confined with making your own decision or managing your own funds or controlling your own finances. It is beyond that now. It does not push you or confine you with just decision making or giving you ownership to make decisions. No, you can intelligently have your own custody while having access to the infrastructure which is also intelligent. So this is the distinction. Now you understand how self custody is effective in terms of interaction with external apps, external platforms, or how technology is evolving over self custody. It means retaining ownership while leveraging systems that can manage complexity. If we connect it with real world, for decades institutions operated this way. Now it is very simple. Capital owners in the past rarely executed every decision themselves. They relied on portfolio managers. They handed over their capital to skilled portfolio managers, and they only cared about profits. They only cared about effective risk management, effective preservation of the capital, nothing else. So they relied on portfolio managers, risk teams, trading desks, allocation frameworks. The owner maintained ownership, the infrastructure handled execution, because that time everything was manual, but still the custody belonged to the owner, but the execution was handled by those portfolio managers. Similarly, now it is bouncing back to the old technique of controlling the custody with itself, but giving the allocation to the framework that can have handled execution of your wealth, that is managed and controlled and owned by you. The future is not self custody versus infrastructure. The future is self custody powered by infrastructure. If you guys have a pen and paper, then note this line out. It's very important too. I think this is the fundamental definition of how modern apps are being built and how future is going to look like, and why this matters for Rift. Now you all understand. I guess you understand. Rift's long-term vision aligns closely with this evolution. Not because Rift is trying to replace ownership, but because Rift is designed to enhance participation while preserving ownership. One of the clearest examples is Rift Smart Money, an auto trading engine, of course. Instead of requiring users to monitor markets, constantly analyze charts all day, manage every position manually, users can participate through professionally managed trading books operating inside structured infrastructure. The objective is simple: maintain ownership, maintain flexibility, maintain control, while gaining access to infrastructure traditionally available only to professional market participants. Very simply. That's why it is called smart money. Rift Smart Money. Through smart money, users allocate capital into trading books. Mirror wallet infrastructure synchronizes participation. Portfolio management becomes structured. Risk becomes actively managed. Profitable opportunities can be reallocated dynamically. The user remains the owner. The infrastructure manages the complexity. This represents one of the strongest examples of how self custody and intelligent participation can coexist. Ownership remains with the participant, infrastructure handles the heavy lifting. The biggest misconception: many people assume self custody means replacing banks entirely. That is not the point. The point is optionality. The future may include traditional banks, digital banks, self custody systems, hybrid infrastructure, all operating together. The winners will be those offering greater flexibility and greater control to the users. Let's conclude tonight's session. The internet transformed information through ownership. Blockchain is transforming asset ownership. For decades, financial participation required intermediaries. Tomorrow, participation may increasingly happen through infrastructure directly controlled by users. Self custody is not simply a technology trend, it is a structural shift in how wealth may be owned, managed, and accessed in the future. And that shift is only beginning. Self custody revolution contains ownership, control, participation. That is the foundation of future finance. In the next episode 16, we are going to get into tokenization era, how real world assets are moving on chain. Our topics we are going to cover will be tokenized real estates, stocks that are tokenized, asset fractionalization, digital ownership certificates, global liquidity expansion, 24/7 asset markets, the future of on chain assets. Thank you so much for joining episode 15. I'll see you all in episode 16 on Wednesday.